All right, I get this question all the time. Do I have to pay myself? How do I pay myself? Do I pay myself with a W-2, a 1099? Do I do a draw? And I've seen this happen several times this year where my tax clients paid themselves the wrong way out of their entity. So I wanted to go ahead and do this video for you today. I am Kristen Gunderson with Gunderson CFO and Bookkeeping, and it's my mission to help small businesses thrive. So if this is a topic that sounds interesting to you, like you need to know this, please go ahead and subscribe. And also, if you find this interesting, go ahead and share it out with people at the end. And if you have any comments or questions of other topics you'd like to know about, please put those in the comments too, and I'll take them into consideration. So why is it so important to pay yourself the correct way? Well, one, it may bring in unnecessary taxes or red flags to you with the IRS, which no one wants. No one wants the IRS breathing down their throat, right? Like it's like everyone's like biggest fears to get audited or to get IRS letters. It can also impact your retirement, audits, and cash flow. So what we need to do is we need to start with the right type of entity. And this is key for a lot of people because it depends on what type of entity you are. It depends on how you're supposed to pay yourself. So let's start with, are you a sole proprietor? Are you a single member LLC? If that's for you, this is your topic right here, right? So if you just have like a DBA or an LLC, um, you take no payroll. You do not get a W-2. The only payroll that you'll be doing is when you actually hire employees. Okay. So you do not get paid a W-2. What you do is you take a draw. And whenever you take a draw, it shows up on the balance sheet of, say, QuickBooks. And it should say like owner's draw. And that's where you put that money. Also, with this, whatever your net profit is in that business, you will be taxed on self-employment tax, Social Security and Medicare tax, which is 15.3% on your whole net income. So there may be some extra taxes there that you don't necessarily need to be paying. There's a right threshold of when you should switch out of just an LLC and go into an S-Corp. That's things that we can talk about during our discovery call. Ultimately, if this is your entity type, I do recommend setting aside 25 to 30% and putting into your savings and doing estimated quarterly taxes. Once you start paying, you really having to owe when you do your tax return, you really should start paying that in, or to have it when your taxes are due. Like you have that money there and it doesn't come as a surprise. And you're like, oh my gosh, I don't have the money to pay my taxes and I owe, say, $15,000 and it's a big surprise to you. That's why I recommend setting aside 25%. If you're 25% is if you're in a state where you don't have to pay state sales tax. But if you're in a state that you do have to pay state sales tax, I recommend putting away that extra 5% and saving up to 30%. One other business that I didn't talk about here is if you're a partnership. If you are a partnership, even if you're not an LLC, but you are a partnership, you're doing the Form 1065, you have K-1s coming out, you do not pay yourself W-2 here either. You basically follow this rule. It will be considered a partner draw instead of an owner's draw, but you are also subject to all of the self-employment tax on the net income. And again, I do recommend the 25 to 30% having that saved. All right, so now if you are an S Corp, this means that you started as an LLC and then you've done the Form 2553 to elect to be taxed as a S Corp. Now you must pay yourself a reasonable salary. We actually have a tool for what that is. We can go ahead and do that for you. If this sounds like something that you need, you're like, I don't know what I should make. We can go ahead and do that for you. We'll have a questionnaire and we'll go ahead and fill that in, and then we'll work together to be like, okay, does this sound like what you do? Because as entrepreneurs, you're not just doing whatever your job is. Like you're also HR, you're shipping, your customer service, you're the receptionist, you're taking out the trash, like you're cleaning. Like there's so many other tasks that the business owner is doing. We need to take that into consideration when we're figuring out reasonable comp, because otherwise it may be higher than what it should be because you're doing all this other stuff. And so that's why I always like to do the reasonable salary, reasonable comp reports, and then we have that good backup for you in case you do get audited by the IRS. So you have to pay yourself a salary. That is like if you're taking out distributions from the company, you better make sure you have a W-2 paycheck coming from the company because otherwise that's a huge no-no. Big red flag for the IRS. So your salary is going to be taxed at payroll tax rate. So you're going to have your Social Security, Medicare taken out. The other half of it is the employer Social Security, Medicare that gets to be deducted from the business. And then this is a huge key. This is like one of my favorite things I love to do with an S. I love to show people like if they're just an LLC, a sole proprietor, a partnership, I love to show them how much money they're going to be saving by switching to an S Corp because now all that net profit that they make is not subject to the 15.3% self-employment tax. You don't have to pay that anymore. The only self-employment Social Security, Medicare taxes that you have to pay is in your W-2 paycheck. But the key is that you must run payroll. You have to run payroll. It has to be paid throughout the year. So even if it's quarterly, like that's fine. A lot of my owners will pay themselves monthly. And then if they need extra money throughout the year, they'll take it as an owner's draw. All right. If you are a C Corp owner, so you have a C corporation, most people do not have C corporations, just for you know. But if you are paid as a W-2 employee, you have to get paid as a W-2 employee. And then the net profit, if you want to pay out dividends based off of how much net profit there is, you have to have that company board meeting and go ahead and be like, okay, we're going to pay out X amount in dividends. And then you get a 1099 and whoever else gets dividends gets a 1099. Um, and then the reason why people don't like corporations, C corporations, because it's that double taxation. So one, they're getting taxed, as the employee, they're getting taxed on their dividends. But then, as of this year, and last several years, but as of 2025 still, then whatever the net profit is the corporation has to pay income tax. It's 21%, flat fee across the board, 21%. You're paying that from the business corporation to the IRS. Flat fee, 21%. All of the other businesses I've talked about flow through to your personal. So you're either putting it as a Schedule C on your tax return, it's flowing in as a K-1 onto your tax return, and then you're paying it on your personal side. The C corporation, you're paying it on the corporation side. But it also, one of the benefits, the perks of having a C corporation is that it opens the door for strategies like a ROBS. I'm a big proponent of using the ROBS. You also get fringe benefits. If you're a C corporation, if you're a 2% owner or more, that stuff's taxed, whereas here you get to write it off on the C corporation. And then there's obviously like retained earnings. All right, so how much should you pay yourself? Well, I'm not going to tell you how much you should pay yourself. Come talk to us. Like it's different for everyone. We need to go ahead and do that reasonable comp report for you. It takes into consideration things like market salary data, all of the different hats that you're using, and it takes into consideration that like we have that tool and I will help you use it. That way we have the proof of what you should actually be making. The other thing that we need to consider is what is the profitability and the cash flow of the business. A lot of business owners, when they first get started, they can't even pay themselves. And then the other thing is I don't want you to take out too much from your business and starve your business. I want you to have good cash flow in your business for that your business can survive. Let's get up to 3 to 6 months worth of expenses saved up for that in case there's an emergency, like you can withstand it instead of having to close down the doors or get a loan, file for bankruptcy, worst case scenario, right? And then also the next thing we need to take into consideration is how to optimize your taxes for you. So those are things that we take into consideration when you ask the question of how much should you pay yourself. All right. Last thing I just want to talk about real quick is there's a risk of just taking money out. Like, don't be commingling your accounts. Don't be paying your personal out of your business and your business out of your personal. That's commingling. That's piercing the corporate veil. If you have an LLC, the whole reason for the LLC is to protect yourself against liabilities. If you pierce that corporate veil, you're screwed. Like, there's not an easier way to say that, but you're SOL. It basically, if you were to get sued and they see that you're commingling your funds, they'll be like, well, you're not treating this as a business. So the LLC goes out the door and then you just lost your liability, the whole reason why you have it. The IRS also expects clear records. So if you're in business and you don't have a bookkeeper, I highly suggest that you have a bookkeeper. We do that also, surprise. We can take that off your plate. Let us focus on that instead of giving that headache to you and then being months behind. You should be able to run financials at any time and know exactly where your company stands. Also, if you're just taking money out, it can lead to misclassification, can lead to penalties and a mess at tax time. And again, that's why it's really important to get your books done timely every single month. And always document how and why you're paying yourself. If you're an LLC, you should have corporate minutes done every single year, and you can put in the minutes like what you're paying yourself. All right, so here's just a quick summary of what type of entity you are and how you should pay yourself and what the benefits are. And my final thoughts are the right way depends on your structure and your goals. Paying yourself is not just about getting money, it's about protecting your business, your taxes, and your future. Don't guess. Let's go ahead and plan. Book a discovery call today if you think that this is for you. Have a great day.